stock valuation, and this is chapter number 7. First of all, we need to understand the stock valuation. Okay, before understanding the stock valuation, we need to see that like bonds, stocks are also the securities that are issued by the companies to raise some funds. Why companies raise funds? Of course, for the investment, right? For the investment needs, company also do the equity financing, so that is called equity financing, like bonds. Okay, bond was the form of debt financing, while stocks are equity financing. Okay, so the valuation principle, if you see in our bond valuation chapter, what is the valuation principle? For the valuation, you need to understand that when we say the valuation, in the valuation we normally compare our benefits with cost, right? So that is basically cost benefit analysis. Okay, we remember also in our first lecture that valuation is based on the benefits and cost analysis. Okay, so first thing first, when we were doing the valuation, we were saying that the valuation or price of anything, I'm saying the price of anything mean either it is a bond, right, either it is a stock or any commodity, anything, right, is equal to the present value of future benefits. Okay, so this is the principle. If you are doing the valuation for any stock or any bond or any commodity, you need to understand that the price is equal to the present value of future benefits. So future benefits are called expected benefits, right? Expected benefits. And when we say the present value, so it means this benefits is reflected here. And how is this cost reflected? When we do the present value calculation, we need some discount rate. Discount rate is basically our cost or maybe our rate of return. Okay, so it means we need to have some expected cash flows as well as some discount rate to calculate any price. Okay, so this is our rule. So what is the valuation principle? Shares can be valued in exactly the same way as bonds by calculating the present value of all future cash flows. Okay, so in bonds, what were the future cash flows? In bonds, basically the coupon payments, right? And they were fixed, right? We knew that what are the coupon payments, and also so you were getting some maturity value or future value or face value, right? So these were the benefits or the expected cash flows, coupon payments, as well as this one. You were supposed to get this one. Okay, and what was the discount rate? Discount rate was YTM. YTM was your required rate of return because you were expecting that interest rate may go high, right? Or based on your expectation of interest rate, you actually divided your cash flows with YTM to get the price. Okay, so if you see in the bonds, things were quite fixed. Coupon payments, coupon rate, right? And it was easy to find YTM. But when we are doing the stock valuation, the case is relatively different than the bonds. Why? Number one, first of all, the size and the timing of dividends. Remember, the dividends are the cash flows for stocks. For bonds, coupon payments for the cash flows. So for the stocks, dividends are actually the cash flows. So we don't know how much is the size of how much is the size of the dividends, as well as what time company is going to pay dividend. Sometimes companies they pay more profits or more dividends, sometimes they don't pay, sometimes they reduce their dividends, right? So we don't know. And also we are not sure about the timing. Sometimes they don't pay, right? Sometimes they pay. It's up to the company. Okay, so it means the companies who are in the growth stage, they don't really pay dividend, so we are not sure about the timing and the size. But mature companies, we know that they pay relatively good amount of dividends. Okay, next, common stocks or stocks are perpetuities in a way that they have no final maturity date. So like in bonds we had N, we knew that after some time the bond will expire, but the stocks, they are perpetual, so they have no maturity date. Okay, number 3, rate of return on common stocks cannot be directly observed. Like YTM, in YTM it was easy because it was related with the interest rate, right? But how much should I expect from a stock is a very tricky question, right? And this cannot be measured directly. We have to calculate it indirectly. So it means if I have a stock, this investor has bought a stock, right? So when he was buying this stock, he paid some money. For instance, he paid $50 for this stock, okay, and he held it for maybe 1 year. He held this stock for 1 year. So on this stock nothing was written, right? Only just face value was written, that maybe this stock was for $10, but in the market it was selling at 50, right? Okay, so this stock, he kept this stock for 1 year. So after 1 year, at year 1, company has given him some dividends, maybe $5, right? So first return that he will get is $5 is the dividend. So first cash flow would be $5, and this is in the form of dividend, right? And the next, now that stock that was 50 at that time, after 1 year that stock is for 60 now, right? So it means other is due to change in price, right? So he bought that stock for 50, but now that stock is for $60, so he can still earn $10. So 60 minus 50, $10 is another cash flow, right? So you see there are two types of cash flows, one in the form of dividend and other in the form of change in price, right? So change in price is called capital gain, right? Capital gain, and this is called dividend, right? So there are two types of cash flows that the stockholder normally receives. One is the dividend and other is capital gains, right? Okay, so for instance, if the companies they don't pay dividend, they may help you in increasing your capital gain, right? Okay, so if they pay more higher dividends, normally the capital gain would be less. Okay, so it means if we say what are the cash flows, cash flows basically are coming from the dividend plus change in price, right? So remember, this is the cash flow. The first part we have done that, right? Next is what is the discount rate? Discount rate, we don't know, right? So it means what is the discount rate, or we can also say what is the rate of return, we need to calculate. Okay, so this thing we know, and this thing we will study in the next slides. Okay, so if you say that there are two potential sources of cash flows from owning a stock, number one dividend, number two selling the shares. So this is negative P0, mean today he bought it for 50, after 1 year he received some dividend and some change in price. If for instance the price P1 mean after 1 year is 60, right? So the total return is D1 and P1 divided by P0, right? Negative 1. So you will be confused like how did we get this formula? I will explain, okay? So it means I can do that dividend divided by price plus change in price divided by initial price. So this is called dividend yield and this is called capital gain yield, right? Or capital gain rate. So what is the total return on the stock is equal to the cash flows divided by initial price negative 1. Okay, so what if I ask you, can you find me the price from this formula? You will say yes, we can do that, is equal to D. So it would be equal to, let me do that, 1 plus RE is equal to dividend plus P1 divided by P0, right? So if I take it here, P0 is equal to D1 plus P1 1 plus RE, you see. So this is called the discounting and these are basically the cash flows. And remember, this is what? This is the price, today's price. It means if I'm staying here, the today's price was 50. How did we get it? Through this formula, right? So it means that today's price is equal to what I'm going to get after 1 year and what is the expected change in price, right? So that is basically the today's price. Okay, so can you see now the valuation principle is basically the present value of expected cash flows. So for present value we are using this discount rate and we are using RE, mean return on equity. Okay, now what is the dividend yield? Dividend yield always mean that we are dividing something on price, right? So dividend divided by price gives you dividend yield, right? So that is $5, right? And then divided by initial price, that was actually 50. And capital gain is basically the change in price divided by original price. So change in price divided by original price, so 10 divided by 50 for instance. So you will get the capital gain rate. So let's see some question, or maybe before getting the question we need to understand this formula. I just explained this to you, that the price of anything, or in this case price of the stock, is equal to the expected cash flows. These are expected cash flows divided by some discount rate, and discount rate is return on equity. So how much should be required on such stock is based on our expectation, right? So that is called required rate of return on equity. Like in bonds we had YTM, right? So how much we should require on the bond was based on YTM, and YTM was based on some interest rate and expectation, right? So same goes for the stocks. So change in price plus expected dividend 1 plus RE gives you current price, and this is called the valuation, right? So what exactly is this RE then? So this is, we need to see it from the two perspectives. Number one is, this is the perspective of the investor and this is the perspective of the company. Okay, investor actually paid some money to buy this stock, and he is thinking that he should at least get this return, right? Return, he should at least get this return. So this is the return from the investor perspective. Okay, so RE is the return from the investor perspective, but that dividend or anything that goes from the company, goes out of the company to the stockholders, it is basically cost of equity. Okay, so this is return on equity for the investor, and this is the cost of equity for the companies, because companies, they issued stocks to these shareholders, and shareholders, they have given them money, right? So for the company it was financing, and for the shareholder it was investing, right? So whatever is the return for the investor is basically the cost of equity for the company. Okay, so these are the two perspectives. So as an investor perspective, RE is the expected total return of stock, also known as the opportunity cost of capital, because if this investor invested this money in something else, somewhere else, so he is now investing in the stock, he should at least get that much, right? Defined as the expected return of investment available in the market with the equivalent risk. So from the firm perspective, it is actually the equity cost of capital or cost of equity. Now let's see the question and we will understand it practically. Suppose you expect long drug stores to pay an annual dividend of 0.56 per share in the coming year, okay, and to trade 45 per share at the end of the 1 year, right? So it means this is today, and what is the expected at the end of the 1 year, that this will pay a dividend of 0.56, as well as the price would be $45.50, right? So this is the expectation at the end of the year, because we don't know what will happen at the end of the year, so we can just expect. If investment with the equivalent risk to the long stock have an expected return of 6.80, so as an investor I am buying the long stock, this stock, but I don't know how much should I demand the return from this stock, right? But what is the other alternative? So similar stock actually has already paid a return of 6.8% to the investor, so I would at least demand 6.8%, right? Then I will discount them at 6.8% to get the today's price, like how much should I buy this stock if my required rate of return is this one, expecting that it will give me dividend this much and price this much, right? So how much is the price? Cash flows divided by 1 plus RE, so that is 43. So it means I am willing to buy this stock at 43.13. So that is my P naught, right? Okay, so at this price the dividend yield is, how much is the dividend yield? 0.56 divided by this price, dividend yield. And what is the capital gain yield? What is the difference? You need to find the difference divided by the price, right? So you can do that. Okay, now so just for the formula, if you see, if I want to find this one, so this was capital gain rate was equal to P1 minus P naught divided by P naught. So 45.5 minus 43.13 divided by 43.13, so that is exactly equal to 5.5%. Okay, now let's see the stock. In the previous case we just saw an example of the stock valuation for a 1 year investor. Let's see stock price or valuation of the stock for a multi-year investor. Okay, so for instance the price of the stock is equal to the dividend 1. Why not P1? Because for instance, if you see here, so maybe after 5 years I want to sell it, right? So you will receive dividend 1, dividend 2, dividend 3, dividend 4. So that's why for the first dividend you will just discount this one, second this one, this one, this one, and then dividend as well as the price, right? So after a specific period of time you will receive the dividend. So you are going to discount the dividend of 5th year as well as the price, right? So PN. Okay, so N can be any number depending on your investment horizon, and it could be infinity. So when n is equal to infinity, it is almost equal to 0 and y, and so that's why we ignore this part. Okay, because investment horizons are different and we don't know, so that's why when it gets equal to 0, so no need to use this part. Okay, so if it is infinity, so this part will get equal to 0, so no need. Okay, so as a consequences, all the investors will attach the same expectation to the stocks. So how long actually investors intend to hold the stock, and whether they collect their return in the form of dividends or the capital gain becomes irrelevant. So that's why, because investors, they have different investment horizon, and if they keep it for the infinity, so it becomes irrelevant. So that's why that part is not really used in the dividend discount model. So that's why we use dividend 1, dividend 2, dividend 3. For how many years are we going to do that? We don't know, right? And we are also not sure about the price, so that's why we are ignoring this part. Maximum it can go to the infinity. When it goes to the infinity, then it becomes nearly 0, right? So that's why we ignore it. Okay, and this formula is called simple or general dividend discount model. So this is the model that would be used as a base for the next few models. Now we are actually now getting into the details of valuation, but first remember, these valuations are coming from our previous model. Okay, so we will consider this model. So these models are based on the previous model. Okay, so for the valuation we can use 3 types of model: zero growth, constant, and variable growth model. And we know that not all the dividends, they remain constant, right? For instance, company has paid $2, $2, $2. So if it is fixed, then it means there is no growth, right? G is equal to 0. So the first model that we will discuss would be zero growth model of dividends, and normally the preference shares. So in that case, the price of the, when they are equal and they are infinity, right? So it would be dividends because they are fixed dividend divided by KE. So that would be, and remember what is that formula? That is actually the formula of perpetuity, right? So it means there is no growth, right? There is no growth in the dividend, so it is fixed. So D1 is equal to D2 is equal to D3. So it is, that's why I'm writing it as D, right? And also KE 1 plus KE power 1. We are also not using that, so that's why we are also only using KE or KP, right? So that is the that is when the dividend is actually has no growth. Okay, so when there is no growth for the dividends, so it will be equal to D1 is equal to D2 is equal to D3. So we can use D, right? And when it is fixed, we just use RP because it is fixed. So RE you can write equity, no problem. So that is a simple perpetuity. And then there is a constant growth model. So it means these dividends, they increase or at a constant rate. So that is called constant growth model. And then there is variable growth model. So it means there are different at any stage there is one growth, and then other stage there is another growth. Okay, so dividend discount model, we can classify them based on the level of growth, no growth, constant growth, and variable growth. Okay, so based on these growth rates we have different models. We will study them in detail now. So this is the dividend zero growth model. So there is no growth in the dividend. So dividend 1 is equal to 2 to 3 and until infinity, right? So that's why when we arrange this formula we get this one. Okay, so remember this formula is equal to the formula that we saw, the price of the bond, infinity bond, right? That was equal to this one, you remember? So this is the same formula for the bond. So this is for the perpetuity case, right? Because number one, stocks are perpetual, and also the dividend is fixed, so we can write D divided by R, right? So this is the same formula we also studied in bonds. Let's take an example. Assume Wave Industries is expected to pay a constant annual dividends of 3 per share indefinitely. If the discount rate is 15%, what is the value of the share, right? So that is simple. So 3 is given, discount rate is given, so you can just simply find the price of such stock. And if you see in this question, they did not mention any growth rate, right? Did they mention any growth rate? No. So they are saying the constant annual dividend paid. So that is not constant growth, remember. This is not constant growth. So they are saying constant dividend of 3 every time, right? So that's why we are using this formula. Now let's go to another model, that is a constant growth model. This is model number 2, and here there is some growth, right? G. Assume that the dividends will grow at a constant rate, right? In the previous question it was a constant dividend, but this is a constant rate G forever, right? So when it is forever, you remember the formula of growing perpetuity, that was equal to, in terms of bond, that was C R minus G, right? So same formula we will apply for the constant growth model, right? So same formula we can do that. Okay, so this is called the expected dividend. How do you find the expected dividend? Expected dividend is equal to the current dividend multiplied by 1 plus growth rate power n, right? So if we say, now you have to differentiate two things. Number one, current dividend, and then we have expected dividend, right? If the question tells you the current dividend of the company is 5, so it means that is D naught, so that is 5. If the question asks you that the expected dividend of the company is, so you will say it means D1, right? D1, how do you get D1? So D1 is equal to D naught 1 plus G, right? So it means if the question is telling you currently the dividend is 5 and expected, what is the expected dividend, you need to calculate. But in few questions they directly give you expected dividend without giving, you don't need to calculate D1, because sometimes they confuse you by giving directly the expected dividend, right? So you don't need to do this one. If you do this one, it will become like this. So it will be for D2, right? So next year expected dividend mean it is already this one, no need to calculate this one. But if they tell you the dividend is current dividend, then you have to multiply it with 1 plus G, right? So that's why it is D1. Or another thing, otherwise I can also write it like that, D naught 1 plus G, this part, right? So if I want to find the return on equity, I can rearrange this formula. So that is actually dividend yield plus growth, right? So return on equity is equal to dividend yield plus growth. So dividend yield, how do you find? D divided by P plus G. So this is just the rearrangement of the formula, and G is basically the growth rate, and this growth rate is normally the capital growth rate that you remember in the last time we were mentioning. A return was equal to dividend plus capital gain, and if we divide it by P, we actually get the dividend yield as well as capital gain rate, right? So this is reflected here. Okay, now let's solve a question for the constant growth model. That the question says that Consolidated Edison is a regulated utility company that services the New York City area. Suppose company plans to pay $2.3 per share in dividend in the coming year. This is very important, right? Coming year mean next year. So next year is always expected, right? Remember, this is not current dividend. Okay, so this is next year dividend, so it means this is already D1, right? So no need to do 1 plus G, no need. Okay, if the question says current, then you have to multiply it with 1 plus G. If its equity cost of capital is 7%, mean return on equity for the company it is equity cost, but for the stockholder it is return on equity. And dividends are expected to grow by 2% per year in the future. Estimate the value of the Con Edison stock. Okay, so that is very simple. So P naught is equal to D1 RE minus G. So the same formula of the growing perpetuity we will use here, right? So the price should be 46. Okay, the last model is dividend discount variable growth model. And in the variable growth model, before explaining this slide, I will first jump to the question, and it would be easy again to calculate, to understand this slide. Okay, so there are basically 3 steps. I will explain these steps after we solve the question. Okay, let's see variable growth model. So it means there are 2 types of growth rates, G1 and then GC. Okay, so I'm calling it as G1 mean the initial growth rate, and GC mean the constant growth rate. And remember, when there is constant growth rate, we know the formula should be D1 RE minus G, right? So it gives us what? It gives us price. Okay, remember this thing. When the growth is constant, so we always apply this formula, and when the growth is not constant, we will use G1. Okay, so let's see. A company has just paid an annual dividend of 15% per share, and that dividend is expected to grow at a rate of 20% per annum for the next 3 years, at a rate of 5% per annum forever after that. Okay, now let's understand. Annual dividend of 15% per share, right? Number 1, and the dividend is 15 cents. Remember, this is not percent, this is 15 cents, means 0.1. Okay, so it could be $2, $3, but in this question they have given you in cents, right? So that is 15 cents, means 0.15 per share, and that dividend is expected to grow at a rate of 20% per annum for the next 3 years. So it means the currently company has paid 0.15, and for the next 3 year mean year 1, year 2 and year 3, right? 1, 2 and 3. For the 3 years, this will grow at a rate of 20%. So it means, so this is what? This is D naught, right? How do we get D1? D1 is equal to D naught 1 plus G, right? So we get D naught. Okay, how do we get D2? D2 is equal to D1 1 plus G, right? And D3, how do we get it? D3 is equal to D2 1 plus G, right? So it means first, currently it is 0.15 and it will grow first year, second year and third year. So it means after 3 years the growth rate is 5%. Okay, so it means for the next period the growth rate would be 5% instead of 20%. So it means when the growth is constant, and it is constant, so and it is forever. But remember, here we have 3 years, 1, 2 and 3. So n is mentioned, n is equal to 3, but here there is no information for n, it is infinity, right? So when it is infinity and then there is growth, what formula do we use? We use normally D R minus G, and that is equal to P, right? So this part gives you the answer of P, remember. So P, once we get this one, so it means the dividend, this dividend that we calculated here at D3, so it will be D3, right? So then 1 plus GC, because it will grow for forever, and then GC. Okay, now let's do step by step. Okay, this part is quite tricky, so that's why I'm solving first this question. Okay, so currently it is 0.15, it will grow at the rate of 20% and it will become 0.18. Next year it will become 0.216, and then third year it will become this, and this will become 0.2592, remember. Okay, so that is D1, D2 and D3. So if I ask you what is the present value, you will say that we need to discount it, right? 1, 2 and 3. So after year 3, what is happening? The growth is for forever, right? And when it is forever, we use the formula. The formula would be D R minus G. Which one? Which D? Of course it would be D3, right? Okay, so it means D3 will be used of the previous year, and it will grow at a constant rate forever. So it means 1 plus GC, right? R minus GC. So but this is equal to P, right? This formula is equal to P, so that is at P3, right? So it means at 3 you have dividend 3 as well as you have P3 that you got through this formula. Okay, now so the first step is D1, D2, D3, we got it. Next stage is second stage, that is constant growth stage. First stage is growth stage, and this is constant growth stage, GC stage, and this is G1. So you got it. After that is dividend n plus 1. N here is basically 3. It means after n it is growing with another rate, right? So n is equal to 3. Okay, dividend 3. N plus 1 mean it will grow with the new rate, that is GC. So that is GC, and that is 0.05 or 5%, right? And then REY is 10% and 0.05, so that is 5.4432. So this answer, remember, this answer is at year 3, right? So we need to get this answer back to year 0. So these calculations are, now we are doing it for year 0. Now I'm drawing the timeline again for you. So that is 0, 1, 2, 3, right? So that is equal to 0.18, 0.216, 0.2529, as well as plus you also have what, 5.4432. so this is P3 and this is D3. okay, now we have the timeline and we also have the year and we also have the R, that is equal to 10%. We can discount them back, right? We will discount it for 1 year, discount it for 2 years, and discount it for 3 years, right? So the first dividend discounted for 1 year, second dividend discounted for 2 years, third dividend we also discounted it for third year. But this one is not dividend, this is actually the price that you used, that you calculated using the constant growth model, and you got this answer. So your price should be 4.63. okay, so let me get back to you the slide again. So the first step is to calculate the dividend at the end of each year. So the first step would be 0, 1, 2 and 3. We need to calculate this one, D1, D2 and D3, and this period is first growth period. okay, next period is GC period. GC always gives you PP, price. okay, if the firm is expected to grow at a long-term rate G after year N forever, then we can use the constant dividend growth model. So that is equal to P is equal to D divided by R minus G, because we will use the D of the previous year, so for the next year, so that's why we are going to do DN, mean after 3 years it is going to change. So D3, this will be, dividend will be of year 3, but now it is going to increase by GC, right? And then R minus GC. So this would be at PN, mean at year 3. okay, so this will also be 3. So after you get it, I don't know why is this L coming after every slide. So P is equal to, now you need to discount it once you get everything, 0, 1, 2 and 3. So at 1 you have D1, at 2 you have D2, at 3 you have two things, D3 plus P3. So you need to discount them back to 0, so you will get the answer. okay, now so as we know that there are 3 types of models for the dividend. Using dividend we can find the price of stocks, right? Price of stock. So that's why that is stock valuation. Stock valuation using dividend, right? Using dividend, and in dividends we got 3 models already, that is zero growth, then constant growth, and then variable growth. But these models, they have some limitation, right? First limitation is that the cash flows are uncertain. Cash flows in stocks are uncertain, like dividend. Sometimes the companies, they pay dividends, sometimes they don't, so our estimation or forecast could be different. But in stocks, if you see, in stocks they are not uncertain. You have to get cash flow after certain period, right? So dividends actually are uncertain. So if company is not paying dividends, we can think of, okay, this company is not paying dividend, maybe company is using these funds for the investment, right? Or if the company is not paying dividends, we can also think maybe the company is not profitable, it is not good. So dividend actually carries quite a lot of information, right? Number 2, non-dividend paying stocks. So this, if you see, all these models we use dividends, but there are also stocks that do not pay dividends. So that model, and they only they don't pay dividends, so the only cash flow would be capital gain, right? So what about those stocks, right? So we need to modify our dividend discount model. Okay, Okay, I think you have heard about the share repurchase, right? Sometime it happens that the company don't pay cash or don't pay dividends actually, right? Cash dividend. The company does not pay cash dividend. Instead, what the company does? It repurchases the shares of the company. Okay. So for instance, currently the company net income of the company is $200,000 and the number of stocks are 2,000, right? So what is the price of each stock? So that would be 200,000 divided by 2,000. So how much? 20. So it means every stock, the price of every stock is 200, right? So sometime what happens, the company, they don't pay cash dividend, instead it buys the existing stocks, right? So there are two consequences. Number one, the more cash the firm uses to repurchase the shares, the less cash it is available to pay dividends. Of course, less would be available to the to pay cash dividends, right? And what happens if the company has purchased half of the shares, 50% shares, right? Share repurchase, right? What happens if the company has bought 50% of shares? It means now how much shares are left? Number of shares are how many left? 1000, right? But let's say net income is still, considering it is 200,000. So what is the price of every share now? So that is that is 200. In the first case, it was 100. Okay, so now the price of the share has actually increased. So what people get, actually they increase, the book value of the share actually increases, so it benefits the stockholder. In first case it was 1000. Okay, so if you see, the price increased from 100 to 200 by share repurchase, or share, we also call it share buyback, right? So this is another alternative of dividend, that the company does not pay dividend, instead it purchases or does the share repurchase. So share repurchase actually reduces the number of stocks. So when the number of stocks decrease, it actually increase the price, right? So this is the rule. So that is why the companies, so if price increases, of course this is beneficial for the stockholder. He would be very happy, he would get more capital gain, right? So there are two options: either he can get the dividends, or either company can do the share repurchase, and then capital gain increases. So in case if it happens, it means we need to adjust our models. So dividend is one mode of paying the profit, and share repurchase also help the shareholders. Okay, if you see the previous model, all the dividends model, they say that the share is valued from the perspective of a single shareholder, discounting the dividends the shareholder will receive. So it means, if you see, the price of any stock was equal to the present value of future dividends, right? Like in the previous model we actually did that one. Okay, but we need modification in this formula if we are adjusting the share repurchase. Okay, share repurchase. So let's see. Okay, so we need some modification. Instead of individual, we see the total payout model. Okay, so the total payout model is equal to the present value of the future total dividend plus repurchase divided by share outstandings. Okay, share outstanding mean number of shares. Okay, to use this model, discount the total payouts that the firm makes to shareholders. Shareholders may receive dividend as well as repurchases, which is the total amount spent on both dividends and share repurchase. So we need some modification in the formula. So it means we first need to calculate the present value of the dividend as well as share repurchase, and then we need to divide it by total number of shares. So let's see an example. Okay, let's read this question. The problem says that the 3M company has 698 million share outstanding, so number of shares outstanding, okay, and expects earning at the end of this year 2.96, so that is net income, right? So the company plans to pay out 50% of its earning, 50% of this earning in total, right? So paying 25% as dividend and using 25% for share repurchase, okay? So it means out of this total earning, the company is going to pay out 50% and 50% company is retaining, right? So the payout includes 25% dividend as well as 25% share repurchase. If 3M's earnings are expected to grow by 9.2% per year and these payouts remain constant, mean it remains 50%, determine the 3M share price assuming an equity cost of capital of 12%, okay? So this is RE. So let's solve this question. Okay, so what is the net income of the company? That is 2.96. and what is the payout? When I say payout, it doesn't mean only dividend, it means dividend plus share repurchase, okay? So that is 50%, that is 50%, okay? So 50% of the earning is 1.48 billion, right? So it means it would be distributed, right? 50%. So in this 50%, 25% is dividend and 25% is share repurchase, okay? So using the constant growth perpetuity formula, because the question is saying, if you see the question, it is expected to grow by 9.2% per year and it is for forever, and it will remain constant, mean it is forever. So it means we can use the formula of P is equal to now we will not use D, we will use payout divided by R minus G, right? So that is payout is equal to 1.48 divided by R is 12%, G is 0.092, so that is the 52.8. so that is the present value, sorry, this is the present value of the total payouts, right? Once we have this total payouts, we can divide it by number of stocks, number of shares. So 52.8 divided by number of shares, so that is 75.73. so this is also similar, like because in this one you have D plus share repurchase, so that's why you need to first calculate the present value, right? So once we have the present value, we can simply divide it, because that is total, that is not per share, that is total, right? Not per share. To do per share, we actually divide it by number of stocks, and that is 75.73 per share. Okay, so what is the what if I ask you what is the difference between this model and the simple discount model? The dividend discount models, they were done for single stock, right? But this one, it actually calculates first total and then calculates single by using this formula. It means we divide the total payouts divided by number of stocks, so we get this formula. Okay, finally let's do the mind mapping. This is mind mapping of our stock valuation topic. Okay, so as we can see that in stock valuation we have two types of cash flows. One is capital gain and other is dividends. Okay, So in the capital and based on dividends, we can classify the models into three categories. Zero growth dividend model. So remember, these are dividend models: constant growth dividend model and variable growth or the phase growth dividend model. So this is the zero growth model. All the dividends are equal. You can see that they are equal. So when they are equal, it means we can apply the formula of perpetuity. As you can see, d1 is equal to d2 is equal to d3, which is equal to d. So we will apply the formula of perpetuity because there is no growth in this t, they are equal. After that, we have constant growth. So d1 is not equal to d2 is not equal to d3. So it means 2 4 6 8, but if you see 2 2 2 2 2, okay. So when we have constant growth, we call it as gc, okay. So expected dividend from here, if you are here, this is expected dividend, from here this is expected dividend. So how can we get d2? It is actually d1 1 plus g. How do we get d3? It is d2 1 plus g. So how we get d1? It is actually d0 1 plus gc. Gc mean constant growth, okay, and d1 is expected dividend, re minus g. So this is actually required rate of return and constant growth. So this is actually perpetuity formula with growth. And last is variable or phase growth model. For certain period of time like 1 2 3, we have a 3% growth rate. After that, from we have from year 4 onward, we have 5% growth rate, and that is constant. So it means we have to apply the formula because growth has started at the from year 4. So we will be getting the answer of price 1 year less, as you can remember in the deferred annuity. So this is also similar like that, but there is only one difference here, okay. But you see that dividends from year 4, they are constant. So when we will be applying the formula, we will get at p3, okay. So p3 is equal to dividend of year 3, and it will grow at a dividend at a rate of constant growth because it is starting from year 4, okay. So 1 plus gc, it is d4 re minus gc. And we also have dividends here, so we have to discount back to year 0 and year 0, and also this price. So in variable growth, we have to discount back the dividends and uh, the price. Remember, if the dividend growth is constant growth is starting at year 5, so it means your answer would be at p4, okay. If it's starting at 4, it would be p3, okay. And so it means that you will use the dividend of 4 1 plus new g, and here you will use the dividend of 3 1 plus g, okay. So this is the thing you need to remember. Lastly is we have some criticism on the dividend discount model. Number one, dividends are uncertain. We cannot predict dividends like in bonds. We know that what would be our cash flows based on the coupon rate, or we can calculate our cash flows that were certain, but dividends are not certain. And also not all the companies pay dividends. So these dividend discount models, they ignore actually uh, the companies that they pay both dividend as well as share repurchase, or in other words capital gain. So we have to adjust dividend payout model, and this is the adjustment. Instead of dividend payout, we need to take total payout, and this is the formula uh, for the total payout model, okay. Present value of future cash flow mean dividend plus share repurchase divided by number of share, we will get price, okay. So that was all about the mind mapping.